Mortgage rates, what's going on? Why are we getting killed? Why the raise? Let's talk about that. And since today we're going to be talking about treasuries, we're going to talk about bonds, we're going to talk about yields, mortgage rates, US-backed securities, I felt it was only proper to go ahead and get in the proper attire for this. But again, don't get used to it. All right, so what's been going on? I thought Federal Reserve Chairman Jerome Powell said that interest rates weren't going to raise rates. Well, in fact, the Feds haven't raised rates. They don't intend to raise rates, but the rate that the Feds control is the Fed fund rate, and it's actually a super short-term rate. To be in fact, it's actually overnight. So they don't control interest rates on mortgages. Mortgage interest rate is dictated by the 10-year Treasury note. So what the heck is that? So we all know that the US has debt. And how do they pay that debt? One way is they sell bonds, bills, treasury notes. And so they sell that off to investors at a specific yield, a return on investment. Okay, what does that have to do with mortgages and mortgage rates? Let's talk about a mortgage-backed security and what is that? Well, mortgages, a 30-year mortgage, it's packaged up and it's actually sold off in the secondary market. And these 30-year mortgages, they follow the 10-year Treasury note. And why do they follow the 10-year Treasury note? Because investors are looking at the yields. They're looking at the return on their investment. One of the things that they're doing is they're comparing, where should I put my money? Should I put my money in the 10-year Treasury note? Should I buy bonds for that? And so it's nice and safe and comfy? Or should I go ahead and buy something that might be a little bit riskier, a mortgage-backed security, but also have a better return? So we have mortgage-backed securities, we have the 10-year Treasury note. We know that interest rates follow the 10-year Treasury note. So what's been going on? Well, what's been going on is the 10-year Treasury note has been spiking over the past week. Take a look at that. And so why has it been spiking? Well, it all has to do with optimism in the market, optimism in the economy. I mean, if we take a look at retail sales, they rose the fourth fastest pace they have since the 1990s. We take a look at optimism around vaccines with COVID, an improvement there, the numbers there, and with improvement there, we're going to see improvement in the economy. And then we also take a look at the possible injection of another stimulus and how that's going to impact the economy. So all those factors in together is causing just a huge spike in the yield, which again is going to impact rates. And that's why you're seeing rates climb. So does it mean that they might stay there? It doesn't mean that. We'll see how things play out today or tomorrow. Interest rates, mortgage rates are a day-to-day thing. Other than that, that's all I have to say. I'm Gil, and I'm out.